The way that I look at things is not only where the base case and the fundamentals necessarily lies, is where the best risk reward is currently and how people are positioned. And I can tell you that there's a lot of reason why to be pessimistic about Europe, but all of this is already within the price.
Yes.
And hence a lot of the upside positiveness is actually not part of the equation. And there are things that actually make us a bit more positive, whether it is the valuation, the positioning as we've talked about, or some of the potential positive returns that can come from better consumer confidence. If you take a step back, consumer confidence in Europe taking a blip down since the Ukraine-Russia escalation. As your previous guy said, and as we've just seen now, there's potentially some sort of agreement that can happen. That would be theoretically quite a big boost. On top of having a rising income, you have lower actually interest rates in Europe. As a house, BNP is a bit more convinced that we're going to get more cuts in Europe than necessarily in the US.
That is great, and I'm glad I found my man. You're standing, and that's great, but how is it going to manifest itself for our viewers who think, thank goodness, the pessimism of Sedgwick and to a certain degree Cho is being replaced by the optimism of Debbas? How should they be positioned? What should they be looking at? Because obviously not everything is going to be positive straight away.
No, correct. And so the way that we bucket them is in two ways. One is the momentum trades, the one that have worked quite well and we think that have structural winners around them, whether it's defense stocks, for instance, or construction. These are two sectors that we think have a long term. The second bucket is the more contrarian one, which is the China-related consumer, most notably luxuries. Now, the 1,000-foot view that we have here in Europe is that whether we want it or not, China policies has actually shifted over the last 3 months. And a lot of initiatives are coming which are positive, yet zero premium is paid for that. So I'm getting an optionality on better return or potentially better return for a very low premium, as we all do.
Let me just round out some of the sectors we've been talking about this morning. The one that shocked me when I charted it was food and beverage. And we spoke to an analyst this morning about how it was just simply tossed out. I mean, if we're talking about the classic area of the markets that investors have just fled from into year end, it is food and beverage. Do you like that sector? Too defensive, too many issues?
No, we don't really like it. Given that we have a bit more pro-cyclical type of view into next year, de facto we prefer less of the defensive. But I think food and beverage, the way that we talk about it, we believe it's in the wrong postcode. Unfortunately, the different things are happening. There's a change and structural change in behavior. Consumers are a lot more healthy, consumers are more aware. Unfortunately, the young generation are more susceptible to positive news in the sense where they're not really drinking the same way as before, not at all. And so you have that issue, and then you have two other issues, is that usually food and beverage is a bond proxy. Well, if it's not growing at 2 or 3%, and yet you can get $5 on your 5% on your dollar, what would you go in food and bev? And the last point, unfortunately for them, is the GLP-1 and potentially also now the Maha effect with making America healthy again. People are afraid that it's an industry that's going to have second effect both from GLP-1 and also from new policies under the States.